Okay, I will now discuss a little bit professional analysts. Um, Obviously, Self-Managed 360 recommends every investor to take control of their investment, to conduct an assessment of the financial performance of a company, and try to also do the best you can to forecast what could be the stock price movement in the next 5-10 years. We want to invest long term. We don't want to invest based on the sentiment or the hype or whatever emotions that can be um, involved in stock market trading. But there is also a stuff available on the stock markets that should be considered, and it's the analysis and recommendations of analysts. So analysts are often working for financial institutions. They will provide a solid evaluation of a stock they're following, of a company they are tracking, and they will conduct evaluation models. They will conduct forecasts for the next year, 2 years, 3 years. They will provide a target price for the stock for the next 12 months. They will provide information on whether they would recommend or not to purchase the shares of a given company. So it would be unwise not to use this information to our advantage. So we will include as well the analysis of what the analysts are saying about a company before investing into a company, or before selling a company we own, or during the ownership of a company, the shares of a company. So we're not financial professionals, and most of you that are listening to this video are probably small investors. So we should definitely use whatever is available out there to help us in our decision-making process. So analysts are professionals, financial advisors, financial analysts. They provide their inputs on companies based on their financial performance, past historical performance, but they also try to forecast what's in store for the next 2, 3, 4, 5 years. They normally try to provide an outlook on the market in which a company is operating, and they will compare a company to its competitors, and then they will provide a recommendation. So the recommendations are often based on a 5-point system: strong buy, buy, hold, underperform, or sell. Sometimes the words can change to overweight, underweight. There's different ways of doing so, but as you move from 1 to 5, some systems I've seen 1 to 6, as you move down, the more analysts that are providing a recommendation of hold or underperform on a company, well, that may be a red flag. So what we try to do is to invest in company. Normally, companies are tracked by more than one analyst, depending on the size of the firm. Maybe three analysts tracking a company, sometimes 25. So obviously, the more the better. But sometimes it's not possible to have more than 3 or 4 recommendations. But we'll try to invest on companies that has the average analyst proposing to buy or strong buy. Obviously, some analysts will be in love with the company and they will be strong buy all the way. Some may not like the company for whatever reasons. They might provide a recommendation that is on the sell side or underperform side. What we want to look at is the average. We don't know the analyst. We don't know if they are accurate or not in their assessment. However, if 25 analysts have an average recommendation of buy, I would feel comfortable that that can be a positive when I complete my the evaluation of a company I'm interested in. Analysts also provide outlooks on various informations. They will provide a price target for each stock they are tracking. Normally the price target is in 12 months. So they will try to predict where the price of the stock will be in 12 months. Again, if there's 20 analysts, there will be 20 different price targets. So we want to use the average in order to satisfy our needs of justifying if we're correct with our assessment or not. They will also provide, or some of them will, growth rate of their revenues or their profit for the next 5 years, which is very useful if you want to conduct a discounted cash flow model, or if you just want to invest in stocks that have high growth potential. Recommendations, price targets, growth as well. If you have various inputs from various analysts on the same company, use the average consensus. Not the most optimistic, not the most pessimistic. Try to use the average. That's going to give you a good idea of the general sentiment of the market towards the stock you want to invest in. If the general sentiment of the market is positive and you have conducted your assessment of the company and your assessment is positive, the company is profitable, the company's financial health is good, and then the valuation is good, and then you can comfort your decision by seeing that the average of the analysts are in line with your own assessment, then obviously that's fun. Plus, short term, it's not bad to see analysts to be overly positive on stocks, because it should have a positive impact on the stock. The opposite is true as well. If the average consensus of analysts is negative on the stock, it may put some pressure on the stock downwards, because at the end of the day, analysts will often generate interest in the stock, so they may create more demand than supply if they are positive about the stock, and they may create more supply than demand if they are negative about the company. So, as a quick example, let's say that two analysts believe the company is a buy, and 3 analysts believe the same company is a hold. So the average will be 2 times 2. 2 is often the score given to buy. Then you add up 3 analysts believing that you should hold if you own. If you don't own, you don't buy it. So 3 analysts times 3. So 2 times 1 plus 3 times 3 divided by 5, because you have 5 analysts, gives you an average of 2.2. So 2.2 would be in between buy and hold, but closer to buy. So ideally you want to be 2 or less. Obviously it's sometimes difficult to find 25, 30 stocks that are meeting your criteria, but that are also pleasing the analysts. But around 2 or better is what we will try to look for. You may also see that, for example, a stock sells currently at the market price of 8. Again, that's a fictional stock. It sells at $8. The average target price of 5 analysts is $9.50 in 12 months. That means that if we're paying $8 now, and 5 analysts on average believe that the stock will be at $9.50, they can be wrong, obviously, but they can be right as well, is $9.50. Well, you have a potential upside of 18%, because to move from 8 to 950, it's 18% in 1 year, which is obviously pretty good and quite better than the indexes. Obviously, again, this is only to comfort our decision. If there's a stock you believe that is a solid investment opportunity, and the analysts believe that it's a hold, or they may believe that the stock price will actually decrease from its current market price, well, that doesn't mean you should not invest into the stock, but I like to comfort my decision with positive outlooks from professional analysts, just to kind of close the loop and confirm even more my decision to purchase or to keep a stock.